Ladies and gentlemen, good day and welcome to the Parag Milk Foods Limited Q3 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Brian DePena, Head of Investor Relations. Thank you, and over to you, sir.
Good day, everyone, and a warm welcome to the Q3 FY26 earnings call of Parag Milk Foods Limited. We are glad to have you all join this meeting virtually. For the meeting today, we have with us our Executive Director, Ms. Akshali Shah, our Chief Operating Officer, Mr. Rahul Kumar Srivastav, our Chief Strategy Officer, Mr. Ankit Jain, and myself, Head of Investor Relations, Brian DePena. After the presentation concludes, we will commence with the Q&A session. While asking a question, I would request you to announce your name and organization. For the purpose of completeness, I do want to read out our safe harbor statement. Certain statements in this meeting with regard to our future growth prospects are forward-looking statements which involve a number of risks and uncertainties that could cause actual results to differ materially from those in such forward-looking statements. I now hand over to Ms. Akshali Shah for the opening remarks. Over to you, Akshali.
Thank you, Brian. Good evening, everyone, and thank you for joining us today. As we begin this new calendar year, I wish you all a healthy and a prosperous year ahead. Q3 FY26 has been yet another landmark quarter for Parag Milk Foods, one that reflects the clarity of our strategy, the strength of our brands, and the discipline with which our team continues to execute. Building on our momentum, we delivered a revenue in excess of 1,000 crores for the second consecutive quarter. This, our highest ever quarterly revenue, represents a 14% year-on-year increase, supported by 8% volume growth. This performance reinforces our belief that consumer demand for trusted, high-quality dairy and nutrition products remains strong. For the first 9 months of FY26, our revenue reached of rupees 2,872 crores, reflecting a 14% year-on-year increase with underlying volume of 8%. These achievements provide a solid foundation and underscoring the resilience of our business model. That is, built on a strong brand, differentiated offering, and an extensive pan-India reach. Our core categories, that is ghee, cheese, paneer, continue to be the backbone of our performance. During the Q3, these categories recorded a 12% volume growth, and together they contribute to 64% of the total revenue. They remain pivotal to our scale and profitability. Our new age business is increasingly shaping the future portfolio of the company. During Q3, Pride of Cows and Avatar continued their strong momentum, delivered a robust 123% year-on-year growth, and for the first time ever crossing the 100 crore mark in quarterly revenue. On a year-to-date basis till December FY26, the new age business now contributes to 9% of our overall revenue, up from 6% in the same year last year, reflecting its growing strategic significance within the portfolio. Avatar in particular maintains a strong growth trajectory, achieving six-fold growth in the last 3 years during the same 9-month period. The recently launched protein vapor bar has received an encouraging consumer response, contributing to 8% to the brand revenue, and has now been scaled up for nationwide distribution. Together, these developments reinforce our journey towards becoming a health and nutrition-led organization, anchored by a premium portfolio and align with the long-term shift in consumer behavior towards purposeful consumption. The Government of India notified the provision of the 4 new labor codes in November 2025 in accordance to the requirements of INDS 19 employee benefits. The changes arise from the implementation of the labor codes have resulted in an estimate of one-time increase in the provision of employee benefit of rupees 5.4 crores on a standalone basis and rupees 5.7 crores on standalone basis. The same has been recognized as an exceptional item during the quarter. The commodity witnessed inflation of 20% year-on-year and 6.5% sequentially during the quarter, with the average milk price inching up to 40 rupees a litre. For quarter-on-quarter impact, while the milk prices inched up 6.5% sequentially, the company has been able to maintain a similar gross margin sequentially at 25.9% for Q3 FY26 versus 25.8% for Q2 FY25. Okay, sure. The company has been able to navigate the cost push with pricing and promotion strategy together, improving the portfolio mix. The year-on-year impact, while the milk prices inched up 20% year-on-year, the company has managed to pass on the cost push in a calibrated manner, which led to gross profit growth by 9%, which is in line with the volume growth. In this inflationary environment, the gross margin has come down to 25.9% in Q3 FY26 versus 27.2% in Q3 FY25. This moment entitled by a combination of favorable product mix impact offset by the inflationary impact. EBITDA for Q3 FY26 is 7.6% versus 9% last year, and last quarter it was 8.9%. While the year-on-year EBITDA is impacted mainly due to on the account of gross margin, but the sequentially EBITDA is lower on account of one-time other income of 16 crores during Q2 FY26. Profit after tax and before the exceptional item stood at rupees 35 crores, representing a year-on-year decline of 2%. On a 9-month basis, EBITDA stands at 8.7% versus 8.1% versus 8.7% last year, was down mainly on account of higher employee costs and other expense. However, on absolute basis, the EBITDA has grown by 6.5%, which is 232 crores. While the PAT before the exceptional item grew by 17% to rupees 109 crores, reflecting the underlying strength of the business. Brand building continued to remain a key priority for us. During the quarter, the company further strengthened its brand building initiatives through series of impactful marketing and visibility campaigns across its portfolio. Govardhan and Go enhanced their presence with nationwide reach through Kaun Banega Crorepati and Super Dancer, targeting mass family audience through television and digital platforms. To further strengthen the household penetration and make sure pure cow ghee accessible to wider consumer base, we introduced Govardhan ghee in a 20 ml sachet pack at an affordable price point of 20 rupees. This initiative allows first-time and value-seeking consumers to experience the purity and quality of Govardhan brand without a higher entry barrier. It also supports in increasing trials, daily usage, occasional usage, and deeper reach across urban and rural markets. Pride of Cows continued to reinforce its position as India's most premium single-origin dairy brand through dynamic multi-platform campaigns, showcasing its commitment towards purity, traceability, and quality. For Avatar, our homegrown nutrition brand strengthened its brand presence by collaborating with a Bollywood celebrity, that is Janvi Kapoor, as a face of its overall marketing initiative. This association aligns with Avatar's positioning for fitness, performance, and modern nutrition, helping us deepen the relevance with younger and health-conscious consumers. Looking forward, the milk prices are expected to remain elevated in the near term. The company remains focused on navigating this environment through disciplined pricing, continuous improvement in the product and the portfolio mix, the operational efficiency, and we continue to pursue measured distribution expansion and new product development to drive the sustainable and profitable growth. To conclude this quarter, this reflects the resilience of our business model and our ability to deliver growth while managing industry-wide cost pressures. We remain committed to become a health and nutrition company with a long-term focus on profitability and stakeholder value. I would like to thank you, everybody, for the continued trust and support, and we are happy to take questions now. Over to Brian.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. Our first question comes from the line of Rehan Syed from Trinetra Asset Managers. Please go ahead.
Yeah, good evening to the team, and thanks for taking my question. So my first question is around your Avatar business. So Avatar has kind of crossed the 100 crore quarterly revenue mark for the first time with a massive 23% YY growth. So can you break down how much of this surge is driven by new product launches like tiramisu protein bar versus deeper penetration of the existing portfolio? This is my first question.
For your question,
Yeah.
while Avatar has grown. Hello. Hi, Priyank. Thank you for your question. The brand, which is the new age business combining of Avatar and Pride of Cows, has grown more than 100 crores. It's a landmark achievement again for this quarter. To your specific question, Avatar protein wafer bar as a category, as a portfolio, is now comprising 8% of the total brand revenue.
Yeah.
Okay. And my next question is around the net working capital side. The net working capital is having improved to 62 in FY25. So how has the increase in the quarterly revenue 1,013 crore impacted your inventory levels for the current season? And do you expect further efficiency gains in the cash conversion cycle?
See, while we have not published the balance sheet, so I will not comment specific on the numbers. But overall, as you know, there is an inflation sequentially. So of course, the inventory has moved up in value terms to a sequential impact. But because of a high inventory as at September end, because we were ahead of festive, so inventory has significantly come down during quarter three, which is evident from the LODR financials which has been published, whereby the change in inventory is reflecting 34 crores on a consolidated basis. However, it is lower on account of the inflationary impact, and hence it looks like 34 crores reduction.
Okay. And one last question from my side.
Sorry to interrupt. Rehan, we request you to please rejoin the queue if you have any further questions. Thank you. Ladies and gentlemen, you are requested to please limit yourselves to one question only. If you have any further questions, you may rejoin the queue. Our next question comes from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity. Congratulations, the entire team at Parag Milk Foods for a good set of numbers in an inflationary milk environment. Sir, first question is with regards to milk inflation, and you already alluded in your initial remarks as well as in presentation about the kind of inflation which has been seen in quarter three also. So, typically post the end of quarter, are the milk prices now more stable or have they moved up?
Now,
And also
the
with,
voice is coming a little muffled. Hello,
is
now
this,
it's
is it better?
a little muffled.
Is it better?
Yeah, you can just start with your name. Yeah, it's better now. You can just start with your
Okay.
name and something.
Sure. So, ma'am, my question was regarding the milk prices. Have they been stable post quarter end? And also with regards to the prices of products, how much of the milk price has been passed on till December? And post that, have we taken further price hikes to kind of, take care of the milk price increase?
Yeah. With respect to milk prices, of course, it has inched up on a quarterly basis. On a YOY basis, you would have seen it has increased 20%. Similarly, if you were to look at on a sequential basis, it has increased to the tune of close to 6.5%. Now, when we compare sequential quarter, the gross margins are relatively flat, around 25.9%, representing that we have been able to pass on the price increase, which is of course offsetted by an improved portfolio mix. On a YOY terms, significantly because it's a 20% YOY increase in milk prices, and of course the other commodity input prices. The same has been passed on respectively. This is evident in the gross profit growth. So our absolute gross margin, gross profit has grown by 9%, which is in line with our overall underlying volume growth of 8%. So we have been able to pass on the cost push. Now coming to your question on the price increase further, etc. Yes, we foresee that in the near term the milk prices are going to remain at an elevated level. And we will take due precautionary action when it comes to passing on the pricing cost push. Just for an update, from February we have increased our prices in branded cow ghee, which is Govardhan ghee, to a certain extent to take care of the inflationary impact.
Just to add on Ankit, normally, when the outset of summer, there is a scarcity of milk, the production goes down and the milk prices go up. So next 3 months there will be some elevated prices as far as milk prices are concerned. But as Ankit told that we are going to maintain our pricing power and we will take the necessarily price increase in our product to compensate the price increase of milk.
Sure. And so my next question is regarding...
Sorry to interrupt. We request you to please...
I have only asked one question.
Yes,
only asked one question.
So we request that you limit yourselves to one question only. Please rejoin the queue for any follow-up.
Sure.
Thank you. Our next question comes from the line of Debashish Neogi from Aban, Dubai. Please go ahead.
Yeah. Am I audible?
You are audible, sir. You may proceed.
Yeah, we can hear you well. Yeah, we can hear you well.
Yeah. So my question actually is, more strategically. Strategic question is, we have the highest contribution to value-added products, but our margin is the lowest in the industry. Now, structurally, that should not be. We are there. On top of it, what is happening, we are not able to pass on the price. We are very three strong brands. Now, if I take a longer horizon, of 1 year, we are not able to pass on the price hike. So why is it so? Which is why our margin is static, or it has come down in a 9-month period. So why is it so? Is it because the 30% of the business is creating problem, or is it because we supply to institutions at such unfavorable price that overall the margin table is coming down? Because as a FMCG brand, the margins are a commodity. We are talking about being a health and nutrition brand, but the margin doesn't speak of it. And I'm not looking at quarter or 9 months. I'm looking at 1.5, 2 years. And on top of it, I feel also, there's a last mile leak happening because I've personally worked in the market in Calcutta and Bombay. Calcutta our distribution is weak, very weak to say the least. And in Bombay also, I find the distribution not up to the mark. So I just want to know that we may have great brands, but we may be having last mile leak in terms of distribution. So can you throw some light on the distribution figures in terms of direct outlets covered now vis-a-vis last 1 year? Also the width and the depth of the distribution? Hello?
Great.
Hello.
So we got your questions. I'm just going to break your questions in two parts. One is first you asked about the margins and, where we have a portfolio which is high value added. So how is the margins going to play out in the near future? Right. And the second part that you're asking about is distribution. Okay. Just if you can see the slide on your screen, our gross margin FY23 was 20%, and it's now moved to in FY25 it's moved to 26%. Yeah. So of course the portfolio mix and the channel mix plays a very important role when it comes to gross margins. And if you can see, our continuous effort is actually scaling out to be how you can see that on the screen, that it's inched up by almost 6%. That is there. So coming to the distribution, and I'll go to Rahulji on Calcutta distribution versus Bombay.
See, we have.
Sorry to interrupt. Actually, 23 may be a one-off year. I'm talking from 24 and 25 because 23 we took a lot of write-offs. Maybe the write-off was much more than what is needed. I'm just talking for the last 1.5 years. If your value-added component is increasing, if Avatar is doing well, New Age is doing well, Core is doing well, so then structurally the margin profile should improve in the last 1.5 years. Is what I'm saying.
So if you can see, even with the cost pressure that we have, year on year it's increased by 20%. Yeah, the commodity, and sequentially it's increased by 6.5%. Even in our cost pressure environment like this, we've maintained our gross margin. Yeah, that's because of course of because we have better product and portfolio mix, which was also offset by inflation, because we take our price increase in a staggered or a calibrated manner that you can see. So of course that lag you can see, but we were able to maintain our gross margins.
Just to clarify, FY23 was not the write-off year.
Yeah, just to clarify.
Yeah, Devashish, hi, Ankit here. Just to clarify, the write-off year was FY22 and not FY23. So FY23 was 20%, which is without the write-off, which has improved to 26%. It is hovering around 26%. While we compare specifically, we have discussed that this gross margin considers the raw milk at a landed rate at the factory gate. This is how we look at it. However, our overall target is to improve EBITDA. As the portfolio mix improves, gross margin will certainly improve, and as the
also the channel mix.
Yeah, and also the channel mix. One of the important factor is we have a B2B portfolio of around 30%, which impacts gross margin in a percentage terms because they work on a thin margin as compared to a consumer segment, which is B2C. Overall, EBITDA journey, we can see on the slide 5.7% to 8.5%. Even in current year, on a YTD December, we are at around 8.3%, which is on a similar lines. We are likely to continue on this trajectory. Of course, our aspiration is to move up to double digit first, but this inflation, which is a very heavy inflation, impacts the gross margin in percentage terms. That I think we have amply clarified in the last quarter also, because it was an inflationary quarter last year as well. And this year also we have given a clear explanation that percentage gross margin looks dipped or moderated in an inflationary environment.
So, and also to talk about the pricing power that we have. So if you see for Goas and ghee, we're almost 20 to 25% higher than the second leader. So it also reflects that our pricing power and the brand power in the market, which is there. So all we really need to work on is a better channel mix and, of course, strengthen our portfolio.
Which means the channel mix is diluting, the pricing power in channel mix is diluting, right?
Debashish, sorry to interrupt. May we request you to please rejoin the queue if you have any further questions?
No, I'm not asking further question. I'm just, follow up on the question she's answering, and just follow up, I'm doing a follow-up on the answer, because I'm not convinced on the answer. I didn't ask a separate question.
Please go ahead.
So what I'm saying, actually, is that the channel mix actually is not reflecting the pricing power, which means in B2C, we are able to maintain the margin, but in B2B, it is pulling it down, So that is not a brand should work on, right? So I don't know. I'm saying ultimately it's not reflecting. And the other thing is, I think, we have great brands, great products. I personally tested the product, but I think we are having a last mile leak in terms of distribution. Okay. Any numbers on that front in the last 1 year, how it has moved, both width and depth of distribution?
So, Debashish, as far as distribution is concerned, this is one of our major sales KPI to disrupt the distribution, to have a very massive distribution, as you rightly pointed out. So, one of the June, what we are concentrating on the east and northeast. So, basically, all these seven sisters as well as Calcutta and Orissa. So, last YTD, we have about 30,000 more outlets we have created, and this is what we are working on that with a clear follow-up with the Bizome, which is our sales tool, IT sales tool.
Yeah.
So we do very precise updation on the distribution network increase, and this will continue till we reach to a respectable, in all the states, close to about 10 million outlets.
Yeah, I'll answer on the gross margin front. See, while B2B business, as you're saying, doesn't fetch, doesn't reflect. See, B2B business, one portion of it is largely SMP, skim milk powder. Now, skim milk powder is a commodity. So when we look at the portfolio of ghee plus SMP, we have to actually look at ghee plus SMP combined together to look at the gross margin, because SMP is finally a byproduct which gets generated, which is at times margin dilutive, at times a very nominal margin accretive. So what happens is the denominator with respect to turnover increases because of SMP sales, and thereby it impacts the gross margin in terms of the percentage, because the realization is more on ghee and not on SMP. That's one part of it. In terms of Horeca, the market is quite competitive. We are competitively priced as compared to any other one of our other competition. So that doesn't seem a margin pressing point, but it is the turnover of this kind of byproduct which impacts the overall gross margin profile.
Yeah. Plus, we need to see cheese and whey also in tandem when you look at the gross margins.
Understood. Thanks, Akshali. Thanks, Rohit.
Yeah.
All
We
the best.
should be happy to help you offline. Yeah, if you have further questions.
Thank you. All the best for future.
Thank you.
Thank you. Our next question is from the line of Parikshit Gujarati from Niveshaay. Please go ahead.
Hello, thank you for this opportunity. So my first question was, from the Scuttle channel checks, what I have heard is you have increased the prices of Avatar whey protein 2 times in the last 3 months. And my second question was that what percentage of revenue we are spending on marketing? Hello.
Yeah, so in marketing, we spend around 3.5 to 4%. Last year also was around 4%. Considering the inflationary impact, this year percentage might look little subdued, but we spend around 3.5%. Now your question on Avatar whey protein, I'm not clear. If you can elaborate.
Your voice is a little.
So,
Can you answer?
so from the channel checks, what I got was you have increased the prices of Avatar whey protein 2 times in the previous 3 months. So what was the reason for that? So basically, it decreases our competitiveness, and because we have an in-house whey protein production facility, so our prices should be lower, right? So that was my question.
So let me Yeah, I understood your question now. See, Avatar whey protein, as you rightly pointed out, is created in-house, etc. And you will know that on a comparative basis, the whey protein in India is all imported. So when it is imported, of course, it has a inflationary impact on account of not only FX, but on account of the protein prices overall across the globe. Now, of course, these two factors create a lot of impact when it comes to the competition. We don't want to be again behind the competition. We are almost at par with competition when you will find this. But what is happening is when you're noticing in the past 3 months specifically, in September 22, on 22nd September 2025, we had to compulsorily reduce the prices in spite of the increase in the cost as a part of the GST measure, which we have passed on as a benefit. But as we progress further and as the input material costs increase, because finally the milk, while it is used for cheese, it is used for whey as well. So as the milk prices have increased, as the input prices have increased, we have passed on that cost push even in Avatar as well. And we are quite competitive when it comes to the category that can be searched on Amazon or on our website or any other health and nutrition website like Yuga Life, where you will find us equally competitive when compared to other brands.
Plus, the brand positioning also plays a very key role when it comes to pricing. Brand positioning also plays a very key role when it comes to pricing, and we wanted to be with the leading market, the pricing aspect. So as per the competition, we've put our pricing strategy.
Okay. So just a follow-up question. Why are employee costs jumped YOY by 25%? Why is such a big jump?
Yeah, so your observation is right. See, typically if you look at even in last year Q3, the employee cost has increased significantly. So on a consolidated basis, sequentially the employee cost has increased by around 16%. Because typically our appraisal cycle, the closure on the appraisal happens during Q3. So our Q3 is always heavier in terms of the employee cost because of the arrears payout. Plus, this quarter we also had a small portion of it, but we have added additional hiring as part of our distribution strategy. So we have hired more feet on the ground to a certain extent. So that's a combination impact. But
plus we've doing the plant.
We have commissioned a new plant as well, Thorendale plant, which is at Manchar only. So there was a separate staffing for that. So it's a combination of both. But largely all our Q3s, at least for the past 3 years, you can see it is heavier as compared to Q2.
Thank you. Our next question is from the line of Madhur Rathi from Countercyclical Investments. Please go ahead.
So, sir, taking off from the previous speaker, my concern is also similar that it is beyond comprehension that despite having such a high value-added, so-called value-added portfolio, our margins are actually lower than people who are basically selling milk. And those companies are actually operating at negative working capital, whereas we have a huge working capital, and despite that we have low margins. So it is not comprehensible that what exactly is the issue. Is the issue that our dependence on B2B is too much, or the cheese is the main culprit over here, that we have to maintain a huge inventory and then give huge credit period? And I can see on the balance sheet that we even pay advances to our suppliers. So, I mean, how is this business going to earn a return on capital when we are going to pay advance to our suppliers, pay huge credit to our purchasers, distributors, and on top of that have a huge inventory and then do a mid-single digit operating margin?
Okay. See, while you are comparing like to like on the listed entities, see, there could be fundamental differences. One, when we measure our raw material cost, we measure the raw material at the landed cost at the factory gate and not the pure commodity price which is paid to the farmers. That is one. The second portion which I explained to the previous question also, that our turnover is little higher because the entire byproduct sale gets accounted as a turnover. While when we sell liquid milk, we are selling only milk. But when we are selling ghee, we have to sell ghee as well as the SMP, which is just being generated as a part of the byproduct. So what happens is your denominator increases because of the same. Denominator means I mean to sale. The sale number increases, and thereby it impacts on the gross margin as a percentage. What we look at. Having said that, we have to, while the gross margin in other portfolio is quite high, we have to look at ROC accretion, as you rightly pointed out. And you can very well see on the chart that overall the ROC has inched up from 8.6% to 14.3%, and that is also our target and our vision mission to how to improve on the ROC. Now, coming to your question on the working capital requirement, I think we have significantly improved on our working capital cycle. Our working capital cycle has come down from 75 odd days to now close to 60 days. Again, large part of it we have already corrected in terms of how should the inventory be there, just in time, etc. But whatever is required as a part of the business fundamental, like ripening of the cheese, etc., we need to keep it. While all our other factors in terms of receivable, payables, so overall our net working capital cycle we look at from this 60-day perspective. That's all. So the ethos of our company is to add value in the long term and add the business wherever needed. So we are going and growing our portfolio. We are focusing a lot on NPDs. You would have seen that protein wafer bar, which was launched just in Q1, which was scaled up over a period of time, and now ready for already scaled up now for national-wide distribution, is already got its share to 8% of the total brand revenue in just 3 quarters. So we believe that the way we are looking at improving our profitability in terms of overall EBITDA margin, the same should reflect in ROCE. And since you are observing everything specifically, our overall the debt has reduced, overall finance cost has reduced, which is adding to the bottom line overall. So that's where, while EBITDA growth will be certain muted, but PBT growth is healthy growth.
Thank you.
Yes.
Our next question is from the line of Preet Nagarsheth from Wealth Finvisor. Please go ahead.
So I wanted to talk about the increase in milk prices, and my concern is that given the next year is supposed to be an El Nino year, and with severe summer expected, do we anticipate the inflation in prices to continue north of Q1 also for the next financial year? Can you please shed some light on that?
No, the prices, as I mentioned, that it is also with the seasonality, and the seasonality is basically summer where the milk production goes down and demand is there in terms of ice cream and other products. So there will be some inflation in the last quarter of this, right, up to March, April, and then next year again on the onset of monsoon, the prices start softening. So basically, it will not be continuously increase from this quarter to next quarter to next quarter. But till the summer is there, I think there will be one or two more price increases.
Okay.
And this is
regarding. Yeah. So I also wanted to understand that regarding the FTAs that are getting signed, do we anticipate any risk of protein coming into the country without duties or lower duties that could impact us?
No. In fact, there is a shortage of protein across the world, and basically even FTA, the dairies are not included. They are not included. So the FTA is isolated. Dairy is isolated from FTA. So there is no risk, I would say. That one.
Thank you. Our next question is from the line of Mohit Dodeja from MK Global. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, could you please highlight the breakup in the ingredients business? What is driven by? Is this driven by lower SMP sales? And how should we see the growth here? And for Pride of Cow's milk, what is the growth trend and the milk and the mix of non-milk shares? So because I'm asking because we have been seeing Pride of Cow getting used in Blue Tokai outlets. So just wanted to know the share of B2B for Pride of Cow.
See, with respect to ingredient business, of course, yes, the large part of the degrowth is coming from SMP. Observation is right. However, there is other institutional whey protein also which we sell. There also we have chosen in terms of not to allocate much on the ingredient business, rather to allocate more towards the Avatar protein business. So that has been a conscious strategy to have a lower ingredient business, whether in form of the whey proteins or whether in form of the skimmed milk powder. But your observation is right. Largely it is on account of SMP. Now coming to the share of Pride of Cows. See, Pride of Cows as a brand and Avatar both are our new growth engines, and we've combined it together for all our reporting purposes, and that's why we call it as new age business, which is going to grow significantly versus where it is today, as well as is going to be margin accretive for the company as a whole, because these both are our premium offerings and superior product offerings. So from that perspective, we're not sharing any differentiation or the split between the two. And further question is in terms of the milk supply, which is to the Blue Tokai. See, we always evaluate market if there is a opportunity to create a surplus milk. We can always allocate to the B2B business, but we took it more as a marketing initiative, whereby we are able to place the milk in those outlets, which is a growing chain, and they are going to promote their products along with our
brand collaboration is the new way of marketing, and you see a lot of brands collaborating. So we've done a collaboration with Blue Tokai, and that's why this is one of institution that we do. Plus, to give you a breakup on the plain milk, liquid milk, and value added for Pride of Cow, right now it's too small to actually comment. But if anything in the near future, we will definitely keep you posted.
Okay. Thank you so much.
Thank you. Our next question comes from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, everyone. Am I audible?
You are audible, sir. You may proceed.
Yes.
Yeah. So my first question is, we talked about pricing increases that we have taken for our portfolio on the value-added side. So two parts to the question. One, we have done very good volume growth in the core categories. So, how do we see the impact of, this pricing increase that we are taking in terms of volume growth going forward? And second, since now we will be offsetting the inflation on the milk side largely, and because our new age business is growing much faster, should we expect, some kind of a sequential improvement in margin, or should we stabilize around current level? How should we look at, gross margin, EBITDA margin going forward till the flush season comes into play?
Now, as you rightly pointed out, yes, the volume growth at a category level in double digit for core categories with such a large base is significantly good, and you can see that the performance is there, whether in Q3 or in 9 months put together at a 12%. It's a significant achievement, what we also believe. However, because of the inflation, you can see that there is almost a kind of 8 to 9% inflation, and that's where the value growth is very, very high. But we believe more on fundamentals in terms of volume growth. That's where we have been transparently updating you that the volume growth is 12%. This inflation will continue, will not continue. There could be plus, minus as the commodity cycle changes. So it is better that we focus more on the volume portion. Now coming to your question with respect to if the portfolio mix is increasing, the core categories is growing, the new age share is growing, and how it adds to the overall margin, and how do you foresee it? See, it's a combination of overall managing a business. So at times we take call on core categories, at times we choose to pass on, at times for certain products we choose not to pass on, etc. Every time for every consumer product with every single rupee increase, it will be good for a cleaner supply chain for consumers, etc. Overall, all stakeholders to keep it simple. So from that perspective, we manage it, and this is the art of managing the business. How do we manage the overall and balance the overall portfolio put together? So in an inflationary environment, we have categorically explained the percentage margin always comes down, because what happens is for certain core categories like product, we tend to we pass on the cost push, thereby keeping our, for example, rupee per liter margin keeping same. But because the inflation is there, the margin percentage comes down. Having said that, we have all categorically also mentioned that the favorable product mix has improved or has helped in supporting a sequential gross margin. So it is overall balancing. I would say that the company will overall look into the portfolio and balance it out. We have to more look at how we are growing the absolute EBITDA, how we are able to add to EPS. I think that's our vision mission.
Got it. I have more questions. I'll come back.
Thank you.
Thank you.
Our next question is from the line of Kaushal Sharma from Equinox Capital Venture Private Limited. Please go ahead.
Hello. Hi, sir. Am I audible?
Yes, Kaushal. Hi, you're audible.
Yeah. So very good evening, sir. So my question is on your new age business, which is currently around 9% of our overall revenue. So what is our outlook for this share going forward next 2 to 3 years? And for new, as we are aggressively growing in our new age product, and the milk ratio is quite high in this segment because we require around 10 to 12 liters of milk to produce 1 kg of cheese, and the intermediate product is byproduct is whey, which requires some milk quite high content, and because currently very inflationary requirement. So are we very jump in the inventory or working capital, incremental working capital, because currently we are growing around 14 to 15%. Will this increase our borrowings, which is around 543 crores as of now, that will may impact our margins going ahead? And what is our plan to repayment of our debt, because it's quite elevated?
So you were talking about the new age business, percentage. So based on our, the long-term planning, we have with a growth rate of 15 to 20% per year, our new age business will contribute around 20% in next 2 to 3 years. That is what we are targeting, and it will happen because of the good base now we are having, and now we already crossed about 100 crores per quarter. Based on
yeah. So see, while your observation is with respect to whether we will need more working capital as the new age business is growing. See, the new age business is growing on account of both Avatar and Pride of Cows, and we also have institutional business. So in when it comes to getting into whey, so we don't need to worry on the whey sourcing as such. I think the levels at which we are there and the levels of inventory which we are maintaining, we are not going to significantly increase from where it is. We are looking at in terms of volume. See, while inflation may create a number in terms of the overall value of the inventory, however, we look at more inventory in terms of the quantitative terms. And in quantitative terms, the inventory is, just to update you, is almost same as what was there in last year, December 2024, in spite of the strong growth in the business at an overall level. So it will not the debt levels, etc. Is not going to impact the EBITDA margins as such, because if there is an elevated interest cost, it will be down. But as you see, the interest cost has been coming down as a percentage of sales, so it has come down significantly because there is a reduction in the debt. So while you're talking of increase in debt, see, in last year, as on 31st March 2025, our gross debt was around, on a consolidated basis, was around 615 crores. which as on 30th September is 483 crores, while on net debt is around 435 crores as on 30th September. So we have, of course, reduced the debt levels. We will be conscious about choosing when to introduce debt, etc. However, that's a call we will take because, see, overall we are generating cash flows. If you look at our cash flow from operating activities has increased significantly. 2 years back, we were using the cash flow. Now we are generating cash flow year on year. In half year itself, we have generated 99 crores, which is good to fund our overall capital expenditure program. And in fact, if you look at last year also, we have funded the entire capital expenditure through in-house accruals only. So with that perspective in mind, we are not going to, of course, increase the debt levels. Debt levels versus last year definitely is going to look moderated only, significantly moderated versus what it was there last year.
What is our targeted debt to capital in that case, considering current inflationary environment? And what is the repayment plan? As you said that we will reduce the debt.
See, a large part of the debt is a short-term working capital debt. The long-term debt is a very small portion, which is large. One portion is on account of NCDs, which we are repaying on a half-yearly basis. This was an NCD which was taken in 2021 of around 150 crores, and today the outstanding is around 81 crores. So it's a repayment which is scheduled on a half-yearly basis. Having said that, for funding the additional working capital, we have taken certain other debt in terms of the machinery-related capital expenditure. But overall, it is part of managing the overall debt profile, whether we are borrowing in form of using it for a term loan for a machinery versus using our CC limits. So as of now, we have maintained a mix of both, and that's where we're looking at the overall debt position, not in terms of what is the long-term debt and what is short-term debt.
Thank you. Our next question comes from the line of Vinod Krishna from Avendus Wealth. Please go ahead.
Am I audible, sir?
You are audible, sir. You may proceed.
Yes, please.
Sir, in Govardhan ghee, how much, Akshali ji was saying that our prices are 20 rupees or 20% higher than the competitor. And also the growth outlook on the new age business, what percentage can we expect? Because we are going 100%. I don't think we can maintain 100%, but this 400 will become 1,000 in 2 to 3 years. So we can take like that. So these two.
See, if we were to grow, so okay, first of all, let me answer on the ghee prices. So ghee prices is almost close to 20% higher than the competition. It is not 20 rupees, it is 20%. Okay. What we were mentioning, 20 rupees was the 20 ml sachet. Hope there is no confusion on account of this. Secondly, with respect to the new age business, I think Rahulji just answered that today it comprises 9 to 10%. Our endeavor is how does it we grow the portfolio to double and make it 20% as a part of the overall turnover. Having said that, even if the mix improves in terms of the new product portfolio, the new age business portfolio, growing from 100 crores to 1,000 crores is a 10x jump. While we have seen abnormal jump, you look at 8x, 6x, it has grown significantly. But in 2 years, getting to 1,000 is little far-fetched. However, the endeavor will be to continue the growth trajectory on the similar lines where we have been growing 8x, 6x. We will see how we are able to continue with this momentum and the journey.
Thank you, sir. And working capital is around 60 days, right? We can take that, or 60 to 65 days. It will be around that, net working capital.
Yes. Net working capital is around 60-65 days.
And we can assume the same will continue.
Yeah,
and we will expect.
Assume that.
Thank you, sir. Thank you very much, sir.
Sorry.
Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, we will take that as a last question for today. I would now like to hand the conference over to Mr. Brian DePena for closing comments. Over to you, sir.
On behalf of Parag Milk Foods Limited, I would like to thank all of you who have joined us online. Have a nice evening. Thank you for joining us.
Thank you. Thank you.
Thank you. On behalf of Parag Foods Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.